finance fees, and then there is an operating lease.
There are internal auditors everywhere, then how did that Vijay Mallya fraud even happen?
Gross profit will give me the sales.
Are internal auditors as independent as external auditors?
Hi guys, having discussed the different elements of financial statements and the 5 building blocks of any transaction, let's have a quick revision of what are the 5 building blocks of any transaction before we go into our discussion for today. When we are looking at any accounting transaction, there are 5 things that I want you to be aware of. The first thing is recognition, which basically answers the question, when should you record a transaction? Okay. Recognition answers the question, when. What is the accounting entry is something we'll get into a little later, but the first part is when do you record an accounting entry. The second part is measurement. This measurement answers the question, at what value? Should I record it at 10,000? Should I record it at 1 lakh? Should I bring it down to its present value? Measurement answers that part. The third element that you need to be aware of is presentation. Okay. Presentation is where and how to show that information to the readers of financial statements. This is something that happens on the face of financial statements. How will you show property, plant and equipment? How will you show debtors? Will you show something in the inner column? What value will go to the outer column is the presentation part. The additional information that you have to give as per accounting standards and to make the readers understand items better is the disclosure part. Additional information, useful life of an asset, what is the estimated residual value, what is the depreciation method that you have employed, all of that might go to disclosure. And the last part, which is often ignored, is your derecognition. So say for example, you have an old laptop which has now been retired out of active use. It is lying in your godown and nobody is even looking at it. It is catching dust and lying in one corner. It is of no use to you. When you learn the definition of what a non-current asset is, you will realize and understand better that that laptop lying in my warehouse with no use is basically not serving the purpose that an asset should serve, which is why there is no point in showing it in the financial statements as an asset, which means what was earlier recognized now has to be derecognized. And that is the fifth element. Any transaction that we discuss, any item, any account head that we discuss from now on has to be viewed at from this lens: recognition, measurement, presentation, disclosure and derecognition. With that in mind, let's start with the topic that we have planned for today, which is IAS 16, property, plant and equipment. Now, the discussion on property, plant and equipment warrants a basic understanding of what is an asset. Now, asset to your mind could be something as simple as cash, or this board that I'm using to teach you right now, or this camera which is recording me. All of these are assets, but in essence, any item which an entity owns or controls, which either gets converted to cash or helps in generation of cash, is an asset. Now, your conceptual framework, your accounting standards will give you more clarity on each of these items, as in gets converted into cash or helps in generation of cash. But basically, anything that you own that is legally registered in your name, like my house is in my name, or I wish it were in my name, or an asset that I control, that is, I direct the use of that particular asset. I decide how it has to be used, how it has to be disposed of. If I am making all the decisions, even though the legal title is not in my name, but because I direct the use of that asset, I am the only one who is deciding how to use it, I will still call it an asset, but maybe we learn about that a little later. Today, my focus is property, plant and equipment. Having understood what is an asset, let's try and understand the meaning of one term, that is non-current asset. There are two words in accounting that I am not a big fan of. One is intention, the other is expectation. Now tell me, how on earth is it possible for me to judge your intention or for you to judge mine? If I were to tell you that I intend to hold something for a period of 12 months from the reporting date, the next follow-on question that you would have is, how do I know what is it that you intend? But leaving that part aside, leaving the intention to someone else, let's try and understand, how do you define a non-current asset? Okay, a non-current asset is intended to be held for greater than 12 months from the balance sheet date. So I have this table in front of me, or I'm using this brand new board to explain you something. Maybe in the next 6 months something else comes up and I lose my interest in this and I go and buy a new one. At that point, please don't come to me and say, sir, but at that time you were saying that I intend to hold it. The intention is judged on the balance sheet date. If on 31st of March 2024, if I intend to hold it for more than 12 months from the balance sheet date, there is a high likelihood that I will call it a non-current asset. As kids, the only definition of current and non-current in your 11th standard or 12th standard for you has been less than 12 months current, more than 12 months non-current. That is one of the conditions, but not the only one. What else goes into, classifying an asset as a non-current asset? The first one was that it is intended to be held for more than 12 months from the balance sheet date. It helps in generation of income, / cash. Now I'm making these videos and it's not for my consumption. I know, and I have other shows to watch on Netflix. If I'm making this video, I will sell it. I'm using this board to make the video and illustrate my point. And once I sell it, it will help me in generation of income or cash, hopefully for a very long period of time, because I don't think anybody in this world is going to come and change the definition of what a non-current asset is. So I intend to hold it for more than 12 months. I want it to help me in generation of cash, and it is not held with an, see again that bad word, huh? It is not held with an intention to resell. I don't care about the way I write my R, it changes every now and then, but I hope it is not we sell for you, it is resell. So it is not held with an intention to resell. If all these three conditions are fulfilled, then the asset, the item, the resource that I was talking about is a non-current asset. One additional point that you need to keep in mind is that this could be tangible or intangible in nature. If I'm talking about a patent, what is a patent? A patent is a formula. Say for example, I make one beautiful formula and chart on standard costing and I give it, it's my copyright, it's something that I have created. You don't have the right to use it and sell it in your class. I intend to hold it for more than 12 months. It will help me in generation of cash. Hopefully all of you will come and buy it from me, and I don't intend to resell it to someone. If all these three conditions are fulfilled, it is a non-current asset. And when I say it could be tangible or intangible in nature, this board that I am using is, I can touch it. Although maybe I shouldn't, it leaves marks all over. I can touch it, it is tangible in nature. It is a non-current asset. The first accounting standard that we are going to discuss is property, plant and equipment. And if I were to give it a nickname, I would call it tangible non-current asset accounting standard. Okay. So we started from the 5 key defining ingredients for any transaction. After that, we discussed what is an asset. Now we discussed what is a non-current asset. Within non-current assets also, I ended the definition with saying it could be tangible or intangible in nature. With that in mind, now let's proceed to understand in detail What does IAS 16 property, plant and equipment involve?